Hey everybody, this is Brant from Wolf on Wall Street Trade. This is my first time doing these live streams, and there's quite a lot of stuff on my side as far as programs open and software. So I'm going to do my best to try to keep up with the chat, and I'm going to also try to post this as a video. So if you weren't able to see it live, that you will be able to see it. I like my glasses, nice and bright and funky. So I want to start actually, let me just pull up the chat window real quick. All right, there we go. Hi, Katie. Thanks for joining us. And Ken. Okay, so I'm just going to play a real quick, or I'm going to go through a real quick slide deck. It's just charts I want to capture. I figured this would be the easiest way to just kind of get it done quickly. To recap kind of where we've been, I always like to look at where we've been and then get an idea of where we're going from that. So I'm going to just start with this. Let me just transition over to that. And you should see a quote basically up on the screen from, this is Monday morning of this week. And really what I'm looking at here, you can see highlighted in yellow, the dollar index, which is inverted here in blue because the dollar and yields have had a very, very strong negative or inverse correlation with stocks and with gold. So looking at this, it looked like it was still in this remaining positive position over here, leading. Basically, its weakness was leading or giving room for the stock market to run some more. So I said, consider where the S&P was. This is early in the week. Remember, back at 4,100, where it failed twice, right here at this level marked A. And look at where the dollar is now, how much weaker it is now over here at B. So at this point, the S&P hadn't crossed 4,100. So here's a Tuesday's daily wrap. This is just an excerpt from that. The S&P's full measured move from its October inverse head and shoulders base is 8.9%, which gives us a target of 4,150 or another 1.8% from here. This would also keep the price trend off that October low as an intermediate uptrend with higher highs and higher lows. And down here, the NASDAQ might have the most potential from here with something of a large W base and its measured move 9.6%. So the measured move target was 12,785. So remember, this is Tuesday, the night before the Fed or the FOMC. And over here, this is where the actual target came from. This is a post from all the way back in October, the daily wrap of October 25th. This is looking at that inverse head and shoulders and where I came up with that measured move of 4,150. So that move that I just kind of updated Monday morning really had its genesis way back in October. So we were looking for these bases, and that's what a lot of the measured moves have been based on, and then subsequent price activity where we can kind of tune it in and tweak it a little bit more. So here is back to this week. Here's Wednesday morning, the early update. This is my first update of the cash session. And over here, this one is interesting. So we're looking at Dow Transports. Now, Dow Transports have a tendency to lead Dow Industrials, and I consider them a leading market signal. They're a very sensitive cyclical. They were already starting to break out before the FOMC. It was on the same day as the Fed, but before it, they were already starting to break out of this bullish ascending triangle over here, okay? And that to me was a bullish sign, even though we didn't know what was coming later in the day with the Fed. Here is right before the FOMC, right before 2 p.m., I'm looking at semiconductors. These are another sector that's very economically sensitive and tends to lead the broader tech sector. So you see semiconductors acting well. Generally speaking, they're going to lead the tech sector if it's, more than just a day or so. So we can see them breaking out here of another bullish ascending triangle. And this is still pre-FOMC. That's transports again breaking out of this triangle. Plus they had a much bigger bull flag on their daily chart. So this next slide is just right after the FOMC policy announcement at 2 p.m., but before Powell spoke. So really there are like a few knee-jerk reactions. I always watch the dollar very closely. because the dollar tends to give us like a quick read on whether the message was hawkish or whether it was dovish compared to what the market had expected. So in any case, the only notable reaction I've seen thus far is in the NASDAQ 100, which went green just barely, and the three S&P sectors that have moved somewhat all higher are the three mega cap heavy sectors. So we have like a lot of like kind of knee jerking back and forth between the FOMC policy statement and right before Powell's thing. The only sectors that were standing out, again, are these three mega cap heavy sectors that have really led the market pretty much all of this year and kind of on an increasingly powerful basis. So this is right after Powell on Wednesday. The market was still skeptical and twitchy as Powell read his prepared comments, but the second his prepared statement ended and he opened up the floor to questions, the market rallied. Translation, the market was relieved that Powell didn't have anything more hawkish to add. The fear going into all this was because the markets rallied, that's loosened financial conditions significantly. So the Fed is trying to tighten them to fight inflation, and you have a market that's kind of undoing that by rallying. So the last few meetings, Powell has seemed more hawkish than the policy statement because he's been trying to talk the market down to tighten financial conditions. So the minute his prepared statements were over and it was clear that he wasn't going to do that, the market started rallying, and it just kept on going from there. And just come back to this thing about meaningful moves. It's always, in my opinion, you always have to look for changes in tone and changes in character. They're small things, but they kind of precede those changes in trends. So I'm just go back to that former post. The only thing I've noticed is that those three mega cap heavy sectors were acting better. And this just shows you basically what I had been telling my members when the S&P 500 crosses above 4,100. By the way, this white line is my most shorted index of stocks. We'll start seeing shorts covering, and that's what you can see happening right here. They're starting to be squeezed as S&P crosses above 4,100, and I'll show you why. It goes back to December, and here it is back in December. This is the most shorted index. Here is where S&P couldn't get above 4,100, and you can see the shorts are just piling up their positions. Fail here, they add to more positions. Fail here, they add to more positions. This is why in the last several videos I've been saying there's a lot of potential for a short squeeze because a lot of shorts were winding up new positions over here. This is also why I said when S&P breaks above 4,100, all these new positions are going to be underwater and we'll see a squeeze, which we kind of did. So this is just a highlight from the daily wrap, the final post of the day for the members site. Again, that measured move target for the S&P coming back all the way from October, but then reposted in the beginning of the week was 4150. S&P almost hit that measured move today. The NASDAQ 100's measure move posted last night is still a little bit higher. That's 12,785. And once the measured move hit or is hit, this is the important thing. That doesn't mean the market can't add more to the upside. It means that there's a high probability that prices will consolidate in that area. So when measured moves are hit, the first thing I expect is not more rallying or just a reversal in price. The first thing I expect is some kind of consolidation or correction process. So going into Thursday morning, the day after, this is the early update. It's the first post of the cash market. I have one before the cash market. Okay, the S&P hit its base measured move target of 4150. This was as of Thursday morning. And it looks like it's heading towards 42. So here's 4,100, here's 4,200. There's no doubt the CTA programs are either 100% long or they're in the process of going 100% long. There was a very, very frothy tone to the market Thursday morning, like almost like buying climax. So that's just something to keep aware of as we're moving forward. It does look like the S&P's price is headed to 4,200, which is right up here. And it actually just missed 4,200 by 0.1%. Okay, so here's the next one also from that early update. I'm not saying that I'm concerned when I'm talking about that frothy tone. I'm not saying I'm concerned that this is the end of the rally, but this morning does have the feel of a buying frenzy and traders chasing prices on fear of missing out. The most common thing to happen after a measured move is met is for prices to correct or consolidate. So we're going through that. And then this is Thursday, right around noon. NASDAQ 100 tags its measured move and right to the dollar. Oh, I just lost that slide. Let me come back to that slide. Yeah, right to the dollar. Right there, that 12,785. This was also in the post. So in the early update, unless something changes dramatically, I think the highest probability from here is that prices start a process of correction or consolidation. And this is also in that same post. And here we're looking at the NASDAQ 100 futures and 3C. I like to look at these. They give me a little bit more information, of course, than the cash market because you have all these extra trading hours. Excuse me, a little sip of something. But the point is, we have really good 3C confirmation on this huge run. But look what's starting to happen here. 3C is starting to not confirm. So the air is thinner up here. Market's up like 3% at this point. People aren't wanting to chase it as aggressively. And we can see that this is also, just another confirmation to me that it's more likely that we're about ready to go into a consolidation phase rather than keep on running higher. So I said to my members, if I'm a very short-term trader, I'm taking some profits here. These aren't the kind of signals that would fill me with the confidence to short the index, but rather, as touched on in the last post, start looking for and expecting a price correction, consolidation. And as that develops, we can get a feel for what comes next. And I think that's a couple more slides, only 2 more or so. Dow transports have come within 0.7% of their measured move, which was a huge measured move. Okay, so they were up 9.4% on the week at that point. So that was the measured move. They almost hit it up there at 16,000. VIX is noticeably stronger in relative strength. So usually the S&P and VIX kind of trade opposite each other, like you see right here, kind of like a Rorschach painting. But you can see relative strength here. They're both kind of trending up on Thursday. This tells me that traders are hedging those gains. They're getting a little bit more defensive because we had 3 big mega caps reporting after the close. We had the huge payrolls report Friday morning before the open. So there's a lot of unknown open risk. And that to me is what this is representing, that traders are getting a little bit sketchy, a little bit nervous. Plus, we've already hit the measured move. So that's why I was saying, as a short-term trader, I would probably take some profits off the table at that point. And just another look at the NASDAQ 100. And again, this isn't the kind of thing that tells me, we have a big problem here. This just tells me that we're not seeing strong buying conviction over here. And prices are likely to correct or consolidate. And you can see 3C is kind of even leading lower at this point. And I think this will be, this is the afternoon update on Thursday. The market has just slowed down the bullish roll, and NASDAQ 100 is lingering just below its measured move target after meeting it and then surpassing it. Then it came right back down to it. This seems to be more than a reasonable place for consolidation with measured moves hit in the area. This seems like a good time for consolidation as well. And just so you know what that chart is, that's the NASDAQ 100. That's the measured move. Here it is. It hit it, came a little bit above it, and came right back down. This is what I'm saying. Sometimes they'll surpass it a little bit, but the majority of the time, they will come back down to the area of this measured move and then start consolidating. And this is the last slide of that whole thing. And this is from the daily wrap that night, Thursday night. As I posted earlier today in the NASDAQ 100 tags measured move target post. That's a link for the post. Like what I said, if I'm a short-term trader, I would consider taking some profits here. This is based on the fact that all the major averages have reached their measured moves, and the most common thing to happen next is that price corrects or consolidates in the area of those measured moves. In fact, NASDAQ 100 went a bit above just after I posted that, which happens, but more often than not, prices come right back down to the target area, which they did later, which is what I just showed you. So now if I just transition to telechart, and I'm going to show you the S&P 500. And this is basically where we ended the week. So that's 4,200, that trend line up there. Let me see if I can pull up this chat window because I know there's a lot of chat going on that I'm missing and I'm feeling left out. Let me just take a quick look here. Bob Bates, good morning. Michael, hey, Michael, good morning. Donnie, happy birthday. I missed your birthday. Happy birthday, Donnie. Patrick Flanagan, good morning. No internet on flight, so please record. Yeah, I am recording this and I'll try to post that up. Ken, good morning. What's the best way to calculate a measured move in your experience? Yeah, so we'll go over that. I guess we can go over that right now if you want. But first, let me just show you again what I was talking about with S&P 500. 4150 was our measured move target. That's right here. Look where price ended the week, right there around 4150, and it started in a bull flag. 4200 wasn't a measured move target. This was something I threw out earlier in the day because the market kind of gravitates towards big whole numbers. So if you, a good example of this is if you go to any retail store, you look at an item and it's priced $9.99. They don't price it at $10 because they know the human mind gravitates towards whole numbers. And $10, even though it's only a penny more than $9.99, feels or seems more expensive than $9.99. So that's just a nod to retail understanding this concept that the mind gravitates towards whole numbers. So we missed this 4,200. This was a target on the fly. It wasn't an official measured move target, but missed that by 0.1%. And you could see as we end the week, this is kind of a bull flag consolidation. Let me jump to the NASDAQ 100. Again, there is the target. This is the measured move target at 12,785. Hit it right here. That's when I first posted that post. Hit it right to the dollar. Jumped up a little bit and then came back down and finished right at it on Thursday. So again, we have something that looks like another bull flag, kind of like we had back here. So my point really being is that once those measured move targets were hit, in my opinion, as a trader, it's like time to start taking profits or thinking about taking profits. That doesn't mean the move is over. It doesn't mean we can't have another leg up. But 9 times out of 10, I would say, maybe not quite that much, but more often than not, what you will see is price consolidate, and usually right around that target area, like NASDAQ 100 is doing, like the S&P 500 is doing right here at 4150. And let me show you real quick about measured moves. So we'll, I guess we can use, we'll use NASDAQ in this case, I guess. So basically, you can do it 2 ways. I use a log chart. You can either count points or you can go by percentage. So if you're going to go by percentage, you want a log chart. The first thing you have to be super clear about is that you're not just drawing trend lines just to draw trend lines and trying to see if, oh, well, maybe there's something there. You have to be very objective when drawing trend lines and trying to identify these kind of consolidation patterns. Like I see people draw wedges all the time because they're easy to draw. Almost every rally will wedge and almost every decline will wedge. I don't find them to be highly accurate or reliable. So this just comes back to the point of like over here, you can clearly see a bull flag. And then this is where we got a head fake. I discussed that in last weekend's video. So in any case, what you want to see is a really strong impulsive move that looks like a flagpole right here, right? And this downward sloping parallelogram looks like a flag. So it just looks like a flagpole with a flag flying. Because the preceding trend is up over here, we call it a bull flag. So to get the measured move on it, we can get a percentage measured move on a bull flag, but we can't get an exact target because the longer this consolidates, let me just pull this out here. The longer this consolidates, the further down this kind of trend is going to come. So we get our measured move by measuring the impulsive part. So I'm going to use a little pointer here and just, about where it started to break out from either resistance or where it started to really show some strength. And then just measure that right up to the top. That gives us about 6.1%. Now you just add that 6.1% to the breakout of this bull flag. So let me try this a different way. We'll do like I'll use a little line here because this line is also capturing this percentage move. Is that about right? Yeah. So what you can do is just something as simple as this. And let me pull this down. So if prices were to break out Monday from this bull flag, say around, this would be around noon, that would give you a measured move upside target of about 13,555 or 13,556. But if this consolidates through Tuesday and we don't get a breakout until Tuesday, then you can see it's the same percentage measured move, but our target comes down to, somewhere around 13,385. There are other consolidations that will give you an actual price target, but they can't have these downward sloping trend lines. So one example might be IWM. Let me check it real quick. And pull up my trend. I have a whole bunch of trend lines for this, so let me just make sure I have the right one. Oh, that's not IWM, that's IWN. Well, you know what? I'll draw them in. How about that? So let's just zoom in a little bit closer. I'm not 100% sure what this is yet. This could be something of like an ascending triangle. See if I can get this trend line right or pretty close to right. So with an ascending triangle, again, we look at this the same way. There's the impulsive move. That's kind of what we want to measure from like a breakout point to kind of the top of it. So about 4.1%, assuming that price kind of stayed in this and found resistance here around 199 and kept making higher lows, then we can assume that this is a bullish ascending triangle. What you can do with these two, which is really neat, is just bring these trend lines out into the future. And at the point they come to an apex, you expect price to move. The strongest moves are before they get to the apex, about 2/3 of the way into this. And I think Dow Transports would be a good one to look at for that. Let me just get the right drawing. Yeah, here we go, Dow Transports. So that's a 5-minute chart. And you can see this big, it's kind of an ascending triangle. It's not perfect because it does slope down a little bit, but you can see this broke out well 2/3 into that. So if we kept this, these trend lines going, they'd go pretty far out into the future. So about 2/3 of a breakout from that, very strong breakout when that happens. And then we get this bull flag, just like everything else, kind of hitting its high on Thursday and consolidating. So kind of bullish tone. That was, or still is, the target at 16,000. So it came within 0.7% of that. So that's pretty impressive trade. Give me just a second. I'm going to take a look at the comments again because I can't watch those with the charts and the software and all that other thing. Okay, so Paul K, market selling off on Friday, VIX dropping. What's your take? Yeah, so like I showed in that slide, let me see if I can go back to that slide real quick. Give me just 1 second to find it. Okay, and I'm going to cue this up. So this is exactly, what you're talking about. Here's the slide, and this is the S&P 500 in the candlesticks and VIX in blue. And this was, I believe, Thursday. Just double check that. Yeah, Thursday. So what I was noting already was, this is kind of the normal relationship where S&P and volatility basically trade opposite each other. Kind of looks like a Rorschach painting, where like butterflies or whatever. But here you can see that relative strength. So this was another reason that I was feeling more and more like traders were hedging their gains, expecting the market to have some kind of short-term high, whether that be a correction or whether that be a consolidation or a corrective consolidation. But in my view, the market just, once it hits those measured moves and we have kind of breadth oscillators that are like sharply overbought, I think it's just a very, very high probability that what we're going to see is the market correct or consolidate in that area. Now, if we go through like a little bit more time, price action, we're seeing other leading market signals like high yield credit weakening. The dollar is going to be a real strong one for the market going into this week, because we got some strong economic data out on Thursday. That sent yields and sent the dollar higher, and stocks and equities have both had a really negative correlation to a higher dollar or to the dollar and to yields. So let me take a look again at these questions. And again, feel free, whatever you want to ask, I'll try to get to. Hey, Scott, good morning. Arthur, you made it. Good morning. Okay, so interested in Dennis, how you doing? So my read on the bond, so let's look at TLT. I'm going to pull that up on the chart here in a minute and transition to that scene. Yeah, I'm telling you guys, I thought it was going to be really simple to just get on the webcam, and no, to share charts on YouTube, you have got to download a whole new program, run that in the background at the same time. It is a lot. It's my first time, so I hope I'm doing all right so far. And we'll go from there. Maybe we'll do these every night for subscribers or something instead of the daily wrap. That might be fun. So I'm just getting my TLT charts pulled up. But I can tell you, what really hit the market. And actually, I'm going to just kind of go to the 10-year yield real quick. And then we'll come back to TLT. And I'm going to transition us to that. So you should be looking at the 10-year yield. And I want to take this off a log. Scale it there. Let me zoom out a little bit so you can see what's happening here. And this is a 60-minute chart. I'm going to go to a 2-hour chart. So many of you may remember that in March of 2021, when the Fed was still saying that inflation is transitory, we got a huge inflationary signal from the copper gold ratio. And I think the 10-year yield was trading around 1.5% at the time. And it was saying that it should be at least double, triple that. But because the Fed kept saying, inflation is transitory, yields really didn't move much until finally the Fed had to capitulate on that and admit that inflation was embedded. But you can look at this August rally here in the 10-year yield. Like I said, there's a strong inverse correlation between yields and stocks. So just look at this August right here, the August highs into the, the August lows of yields into the October highs. Now watch the S&P 500, same thing, right? Same time frame. Over the same period, here's the August highs for this, October lows. So the point is, while yields are trending higher over that same period, stocks are trending lower. And then we finally get this break over here in October. And this is where I think the market started to sniff out peak inflation. Getting back to TLT, the question about TLT, we did see bonds start breaking down, or yields, the 10-year yield start breaking down. This was Wednesday, and here's the FOMC policy statement. So this was a breakdown from this little bear flag here in the 10-year yield, which would be very helpful for stocks and for the mega caps in particular. But then we get this jump right over here Friday morning, right back into this kind of bearish flag. So this is not a failed bear flag yet. We do want to keep our eye on it. But this jump is because we had a super strong payrolls report, strong services report. Manufacturing is in recession in the US. But that jump in yields was really due to that Friday morning data, the payrolls and the services. So if we come back to TLT, remember that yields and bond prices trade opposite of each other. And TLT is the 20+ year. But we did have this really nice bull flag. So here is the flagpole. And if you see it, on maybe like a 60-minute chart, it looks a lot more vertical here on a 60-minute chart. And there's the flag. So zooming back into it, we had very good 3C signals right in here right before it's starting to break out, and it did break out. Notice it's pulled back to this bull flag top right here, this top trend line. So this isn't a failed breakout, but we do want to watch it very closely because failed breakouts tend to lead to very fast reversals. As far as what 3C is saying about it, let me cue that up real quick. Taking just a minute longer. I got so many programs open here. All right, I'm going to transition over to a 3C chart of TLT. And that should be coming up for you now. So this is kind of the area of that bull flag. Here's the breakout here. So from a 5-minute trend perspective, and I've been using a lot of these 5-minute charts to represent the market's rally off of its October lows. So you can see right here, this kind of negative little dip here where we're not confirming. That's kind of the start of this bull flag consolidation. And then we get these positive divergences in here. This is what you want to see with the bull flag. Generally, you'll see a little bit of weakening in 3C right as the consolidation starts. So high is put in, time to consolidate. That's what's happening over here. And then a positive divergence as we get into the point where it's about ready to break out. Now, if we look at a shorter term chart that has a little bit noise, but it's much more sensitive, we'll go to the 2-minute chart, and let me stretch this out as much as I can. What you see here is the same thing. Here's kind of the bull flag area right there. There's the breakout from it. So 3C, not horrible, but just kind of slowing down right here at the beginning of this consolidation. And as that bull flag is maturing, you see money starting to come in. That's what you want to see. This is like textbook 3C chart for a bull flag. Here's where it goes wrong though. This is the breakout. 3C does not confirm this higher. Okay, so this is probably, in my estimation, it's probably traders were very nervous right before that huge payrolls report coming out the very next morning, which is right over here. They were nervous to really jump in with both feet with conviction, and I think that's why we have this kind of non-confirming 3C signal. But we definitely do want to watch this because we don't want to see, I'm going to transition back to the price chart. We don't want to see a failed breakout where prices broke out and then came back down here and started to fail, because once that happens, what generally happens after that is you get a really fast reversal. And that's the same thing for, you know, if we were in, well, we had a situation like that last week. I can't remember what it was, but it was a bull trap. So the same thing happens with those bull traps. And I think maybe it was the S&P 500. Yeah, there it is right there. So we had a bull flag and prices broke below right here. So again, it's the same concept that I'm talking about with TLT. You want to watch out for a head fake where that breakout doesn't last. Over here, it was the opposite. It was a bear trap. So new shorts are being drawn in here when this trend line breaks, and then prices move up. So this is the failed breakdown. This is the fast reversal. TLT is just kind of in my view, kind of the opposite. We're just watching for this not to be a failed breakout. So prices can pull back here, stay along this trend line, even come into the flag a little bit, but we don't want to see them come below this flag at all. At that point, the probabilities are that price just drops real fast. So I think it's still okay, but you just have to remember where this is coming from. It's coming from a very strong payrolls report, and that payrolls report has been suspect pretty much all year. So again, let me take a look at the comments here and see what we got going on. Okay. Scott Kluk, the phrase false breakouts, fast reversals, forever in my, yeah. I mean, we've seen a lot of them, haven't we? It's one of the first things. If you don't have a really strong definitive breakout from a bull flag, it's like one of the first things that I get worried about. It's like suspect. If you have a definitive strong breakout from a bull flag, no problem. But if it's just kind of just barely getting over the edge, that, you know, raises my kind of alert antennas, puts up a yellow flag. It's like, okay, we'll watch for this, that we don't get a failed move because they reverse fast. What time frames are most reliable, 3C, or do you find when trends are on multiple time frames are most reliable? Okay, so good question. This is just something you learn over a course of time with 3C and the asset that you're trading, is that different time frames will reflect different trends. So for a good amount of the time from this October rally, we were looking at the 3-minute chart. Excuse me, I'm just getting something to drink. We were looking at the 3-minute SPY QQQ 3C charts, but as the trend develops more, becomes a bigger trend, and right now it's a pretty big trend. Let me show you the SP 500. I mean, we're going on almost 4 months at this point of a counter trend rally or a bear market rally, whatever you want to call it. I think it's a little bit stronger than a bear market rally. I definitely would not call it a new bull market. But here's the October low. And one of the important things about the S&P breaking out above 4,100 is that it kept this intermediate or sub-intermediate trend, uptrend, I should say, alive, because it's making higher highs, higher lows, higher highs, higher lows, and above 4,100, that's the next higher high. So that keeps this, I would call it like a sub-intermediate to intermediate uptrend alive, that whole package of higher highs, higher lows, where if it had failed here again at 4,100, I think the shorts would have just piled into this and we'd have a real problem. But the fact that it did break out above that really is what I showed earlier in those slides, caused a lot of shorts who were jumping in here when they saw this failure to be able to move above 4,100. They were jumping in, so the shorts were loaded up and boom, they got squeezed. I'll just see if I can pull that chart up for you one more time real quick. It doesn't take too much time. Yeah, here it is. So I'm going to transition over to the PowerPoint. Okay, so that is the S&P 500 and the most shorted index that you're looking at in white. My own most shorted index. There's different ones. Goldman Sachs. You can do large cap, mid cap. But what you can see is this is kind of shorts being squeezed. But here's S&P breaking above that 4,100 level on Thursday, and then boom, there's the shorts being squeezed. The reason being, if we look at a little bit longer time frame again, is because last time we were here at 4,100 in December, you can see this most shorted index going down. So the shorts are jumping in, they're piling in when they're seeing this failure of price at resistance. So those were the short squeeze fodder, and why I, in the last several videos, and if you're a subscriber, you read my posts every night, I've said I think there's still a lot more room on the upside for more short squeeze activity, because all the new shorts that jumped in here were still at a profit up until, are still, you know, in the green or just not in the red up until Thursday when the S&P broke out above 4,100. So short squeeze there. I'm not sure if I got your whole question there. Let me see if I did the time frame. So right now, I think the most reliable time frame is on the 5-minute chart. So this is just a thing of, you learn 3C, you learn how it acts, and you adjust it to the trend as the trend grows. So as the trend had grown, we were going to longer time frames to represent that trend. But I'm going to try to show you a little, this is kind of an interesting chart. We're going to jump over to 3C. And what you said, was it Scott? Yeah. And what you said, Scott, is yes, absolutely. The more confirmation you get in multiple time frames and the more confirmation you get among multiple assets, the higher your probabilities that the market's going to move in the direction that you think. So that is actually what 3C stands for: compare, compare, compare. So you're dead on right when you say that. Yes, the more time frames that align and the more assets that align, the stronger the signal and the higher the probabilities. So I'm going to transition over to 3C here. And this is 3C on SPY. Give me 1 second just to check the health of the stream. Okay, it says it's in pretty good health. Okay. So I don't have a pointer that I can draw on this. Maybe I'll figure out how to do that for the next live session. But this is S&P 500 at 3,100 here. Although we're looking at the SPY, this is December where S&P failed twice at 4,100. Look at what the trend chart of 3C is doing, not confirming over here. 3C is not making a higher high at that first test. It's not making a higher high at that second test. So we have a negative divergence right here. And we see prices pull back. I think it was about 8 or 9%. And we get this really dull holiday December range right in here, 2 weeks or so. Very dull trade. You can barely see a few little positive divergences in SPY. Really not that much though. But here's where we start to get some really constructive things happening. If I back up this chart a little bit, you'll see that 3C was leading above the 4,100 level. It was basically forecasting in advance over here above that 4,100 level relative to where it was. It was basically telling us in advance the probabilities were that the S&P was going to break out above 4,100. So the only thing that I would say stands out to me right now is we have a little bit of a relative negative divergence because 3C here hasn't made a higher high. This is completely in line with my expectations that since measured moves have been hit, that our next step that's already started is to go into a consolidation correction phase because we're really, really overbought. But I want to show you QQQ NASDAQ real quick. Is everybody with me there still? Throw me a little message, thumbs up or something. Okay, so looking at QQQ. Aha, there we go. Thank you guys. Thank you. I'll get better at this, I promise. Thank you. Thank you, Jennifer. Thank you, Michael. And Arthur. Arthur can hear. Great. Ken, hey. The dollar ripping up the last couple of days. Yeah. I'm going to touch on that in a second. So if you're a member, you're a subscriber, or if you followed along with the videos like every weekend, you'll know that some of the worst performing stocks of 2022, which was our bear market, some of the worst performing stocks were the mega caps. Now, technically or historically, let me put this caveat in. Historically, some of the stocks that do the best in bear markets are secular growth stocks, which the mega caps, most of the mega caps are considered secular growth stocks. They don't depend as much on the economic cycle like energy or industrials or financials. Okay. So what was happening was the mega caps were getting beaten down hard because there's this kind of FOMO Amazon effect. So I don't remember when I saw this article, but I saw it in the last couple of years. I was like looking back at what had happened a couple of years ago with the situation in trade, and I pulled up, that day and just to see what was happening. It was actually back around 2000 or something like that. In any case, the guy was making a really good case as to why Amazon, just to give you an idea of where we are, how far back, that Amazon was never going to displace Barnes and Noble. So at this point in time, Amazon was largely just selling books. Okay, so that gives you like an idea. And this guy made a well thought out argument, and he said Amazon will never replace Barnes and Noble. Well, Amazon has pretty much since then replaced most brick and mortar. They have their own brick and mortar. So a lot of people are willing to look at these tech companies and a lot of these mega caps, and they're willing to give them very high valuations, but also very far out into the future. Like, not what do we expect, to earn the next quarter. They'll say, hey, what are these guys going to do in 5 years? I don't want to miss out again like I did with Amazon. They tend to give them very forward-looking valuations and very high. And the problem with that is when interest went up, or when, inflation went up and interest rates had to go up, all those valuations had to be marked down. So these stocks that usually do fairly well in a bear market got hit the worst. The only time I saw real leadership, and I know I'm kind of all over the place here a little bit, but like August, we expected a change in character. September, October, expected a base. That base broke out with a rally. The rally was led by cyclical stocks, by pro-cyclicals, and the mega caps barely performed. If anything, they were probably like a little bit of an anchor. But this is one important thing that we saw coming into December right here. There's that December range. We're looking at QQQ. This is a much more positive divergence than what we saw in SPY. So there's probably tax loss selling into the end of year and all that. And, you know, it was kind of an ugly December, as you know. But this had the most significant change in character, QQQ, the strongest 3C chart. And since January started, or this year, they have acted the best. They've finally seen some rotation. And I think the reason for that is because the market is sensing peak inflation, which also means peak Fed hawkishness. And this goes into like the 3 stages of what I expect the market will do next. I was asked about natural gas. I really, to be honest, Arthur, I haven't followed natural gas that much. I'll pull up a chart of UNG, but it's been a while, or we could pull up futures, but I know they've been absolutely hammered. So, you know, going from inflation to, look, if we were in a bull market right now, this is the kind of deflationary signal that would be sending like red flags up for me. And I would be pounding the table saying, guys, be very careful. That's a big deflationary slide. I really don't know what this has to do with Ukraine and Russia and natural gas and pipelines. I don't know, but we'll take a closer look at this maybe next week. It's not something I would be buying right now. It's also not something I would be shorting. You know, this looks like it's probably going to move to like a selling capitulation, kind of gap down and big day down at one point. Okay, let me see what else we have. Oh, damn, I am sorry. I didn't even have the right chart up. So sorry. Told you this was going to be a little... Okay, we're going to go to TC2000. There it is. We're looking at UNG. Yeah, so as I was saying, this looks like a huge deflationary signal. Notice the bear flag right here. I mean, let's just see what happens here if we just draw in real quick. And I'm just going to do a parallel because they're almost always have this kind of parallel thing about them. So if we say, you know, the impulsive break was from here, and that's almost 45%, 44 to 45%. Actually, I should be doing this on a log chart, but I bet it's going to come out about the same. Okay, so let's say it's from here. We get, yeah, let's say 44%. And then from the breakdown, which is right here, I'm just trying not to touch those trend lines. Boom. I mean, it well blew through the measured move, which would be somewhere around 11 for UNG. So again, like I said, I think I really don't know a lot about the fundamentals of natural gas and what's happening with all that, but I would probably expect some kind of a capitulation event at some point, just how nasty this kind of sell-off has gotten. And there's going to be a lot of shorts in there, and then they're going to get squeezed, but I don't see that capitulation event yet. So let me take a look at some more comments and get a sip of water. Am I doing okay with you guys so far? Everything all right? Yeah, Ken asked a good question. Yeah, so dollar, yeah, dollar's been ugly the last couple of days. I'm going to pull up the dollar index and then I'm going to transition to that chart. And this is kind of a interesting learning lesson. You'll have to just have to remind myself to stay on topic here of asking about gold. So let me transition to Thinkorswim. Here we go. And this is a daily chart of the US dollar index. I never knew talking on a webcam would make me so thirsty. So if we look at, I just want to explain a couple things real quick. First of all, the dollar since pretty much the end of the COVID crash, or since the end of basically Q1 of 2020, the dollar has had a very, very strong inverse or negative correlation relationship with stocks. So what we're seeing over here is during that COVID crash. This is just a flight to safety, a flight to cash at the end of that COVID crash. And coming down over here, this is Fed dovishness. So remember, the Fed slammed the Fed funds rate back to 0%. They started buying $120 billion a month in assets. I think 40 billion of that was mortgage-backed securities, 80 billion of that was treasuries. Now, since the Fed can't buy from the Treasury directed auction, they buy them from banks, and then the banks take that money and they put it in the stock market, and that's why the stock market tends to move with the Fed's balance sheet. But in any case, that's what you're seeing here with the dollar coming down, is just the Fed throwing everything in the kitchen sink at loosening conditions to come out of that COVID lockdown thing and try to get the economy back going strong. Right over here is when you're seeing inflation starting to pick up. And then as we get into about March-ish or so, you're seeing the Fed really, really hike rates. And that's what the dollar's reflecting here. So that's why, since about, Q1 of 2020, the dollar and stocks have had a very, very strong inverse relationship. And if you pull in a little bit closer, here we can see the dollar topping in September, right? And then kind of breaking down this trend. This is a 50-day moving average. This is a blue 200-day. This is what traders call a death cross. So this is showing us that there's a major change in character. The phases, the three phases for my subscribers, you know what they are, that I expect from the market. Phase one is peak inflation and peak Fed hawkishness. I think that's what we're seeing here, phase one, and the market rallies to celebrate that, almost like the pivot. We got very, very strong economic data Friday morning. That's why the dollar's jumping over here. Remember, this is a daily chart. So the non-farm payrolls report, the services sector is still doing great. U.S. economy is 70% services. The manufacturing sector is already in a recession. So what he asked about was gold. So gold has had the very same, very, very strong inverse relationship. As a matter of fact, gold and stocks have almost been trading not exactly together, but a very similar trend. I'm going to just pull up an example of that real quick. And from March of last year, when the Fed started hiking rates and tightening their policy. Right now, I'm just setting up this chart so I can show you. Okay, so I'm going to pop back over real quick to TC 2000 telechart. And this is the S&P 500 in the candlesticks, and the blue line is GOD, the gold ETF. So you can see, like, back here before the Fed started doing anything with their rate hike cycle, which started right over here in March, there was really no strong correlation. But then after that, you can see the S&P and gold, or GOD, basically moving kind of in the same direction together. Not exactly the same performance, of course, but trending together because they both were being affected by the same two things, which is the dollar and yields. So what he was basically asking was, we saw gold really outperform recently, and you can see that right over here. It was taking full advantage of dollar weakness. And then we saw a real big drop on Friday, Thursday and Friday. Over here, you can see it on the GOD chart, but we'll actually go to gold and take a look at that, because gold had been acting really good, and Friday, not so good at all. Let me just take the studies off and get this prepared. This is why, in videos, I can prepare all this stuff in advance and edit it, but here we got to do it on the fly. And this is just when I was starting to get really impressed with gold's price action. I have to say, it's a little bit disappointing. Go with maybe a 4-hour chart. Okay. And I'm going to transition back to Thinkorswim. Okay, so now we're looking at gold futures, and this is a 4-hour chart. So what you'll notice over here in October, what did I say was happening with the stock market? We saw bases. We saw the Dow putting in a W bottom, or let's not say bottom because that kind of infers like a new bull market starting, but a base. W bottom, small caps, a W bottom. the S&P and inverse head and shoulders, those were all happening at the same time. Gold was doing the same with the support right here around 1620. So the rally off that has been really strong and steady. You can see a very good, strong uptrend. I'd prefer to see a little bit more consolidation. When things go too parabolic and they don't consolidate, you get a fragile market and you get a higher probability that you'll get a sharp breakdown just out of nowhere, which is kind of what gold did Thursday and Friday. Take a closer look on a 2-hour chart. You can see this price action here. And if I pull up volume too, you can see it's very high volume. So strong selling on heavier volume. This 4-hour chart might offer better perspective. Yeah, so you can see that heavier selling over here Thursday and Friday on heavier volume. This is as the dollar jumped and we had, double-digit moves in yields on Friday because of the strong services report, ISM, and also because of the strong payrolls report. But in effect, gold broke down below 1900, which to me it's a major thing. 1900 is a level it really fought for. It's a level it should have held, in my opinion. And you can see as it breaks down below 1900 right here, look what happens with the volume. So a lot of stops were there at 1900. So I don't know what happens next here with gold. Like you accurately depicted, the dollars jump and yields jump really precipitated this kind of fall. It doesn't look great though. I'm going to say this doesn't look great. I'm a little bit concerned about it. What I would suspect is that we see some kind of bearish consolidation form next week. And if we do see that, we get a measured move and we can say, okay, next leg down. If we don't get a bearish consolidation, we get something more like a short-term base. We got to get back above 1900 for sure. And this was, the next point that gold had to take on was 2000. And last week, it got really close at 1975.20. So it was making good progress. But again, you see how just slow and steady this march has been. There haven't been like a lot of consolidations along the way. And it's like building, a high rise. The higher you build, you have to make a stronger base, which we had a very strong base for gold at 1620. But then along the way, you have to put in support structures, new floors, new support. That's what a consolidation does. And gold really has been more of like a slow, steady climb. Again, back to this 4-hour chart. And zoom in, there's the base again. So a real nice base for it to rally from, but more of a slow, steady climb. Didn't go parabolic, but not a lot of consolidation in here, which I would have preferred to see. So for subscribers, next week, that's what we'll be watching. Do we get kind of a bearish consolidation, or do we get something that looks a little bit more like some support is being put in? But I just did not like that break in 1900 on heavy volume, and a lot of stops got run. So we may see a little bit different tone earlier in the week. I'll pull up the dollar real quick so you can just see what happened. And again, this is a 4-hour chart of the dollar. So this has been reflecting what the market is sensing, that we've already hit peak inflation and thus peak Fed hawkishness. The Fed was hiking 75 basis points at a time. Now they're doing 25. And it looks like they might have 2 more left in March and May. But this move in the dollar right here may not look like a lot on this chart, on a 4-hour chart, but it was huge. Here's on a 5-minute chart. This is all of that good economic data out before the open. And then let me also switch over to yields real quick. Okay. And transition to telechart. And what you're looking at is the 10-year yield. Don't want that on a log scale. And we had this bear flag coming into the week. So the bear flag suggested that rates were going to move lower, which they did. They broke lower. It also suggested that the Fed was going to come in with no major surprises, which basically happened. But this kind of popped back up, which has to raise the alert with just like with TLT of a potential failed breakdown fast reversal. That pop up is all of that data that we got Friday before the open, the strong services report, the strong payrolls report, which I really have no trust in the payrolls report at this point, but it doesn't matter. It's what price does. So that's what you're seeing affecting gold as well. It's not just the dollar moving higher, but gold has had a very strong inverse relationship with yields. So with yields moving higher too. Matter of fact, if we pulled up, I don't know, I haven't even done this before, but let me just see what happens. Let me use IEF, I guess, 7 to 10 year. And we'll put gold on this chart with GLD. I don't know what's going to happen here. I may be wrong, but I suspect. Turn that blue. Yeah, I suspect they follow each other. So IEF is a treasury bond fund. Treasury bond prices move opposite of yields. So you can see a very strong relationship between gold and blue, or GLD, and treasury bond funds, which means a very strong negative or inverse correlation with yields. So Friday morning strong data sent the dollar higher, sent yields higher, sent gold lower. Okay, I'm going to check my comments again. Sorry, I really prefer to be doing this all in live time, but I've got so many things open here. Scott on the AI plays. If you want to send me some charts, I'd be happy to look at them. I really don't do the fundamental stuff. I can tell you a little story about that at some point, but I think everything that I need to know is reflected in price. But if you want to send me some charts you're interested in, just go ahead and email them to me next week, and I'll take a look at those for you. Let's see. There have been a number of thrusts that have occurred recently that only happen at start of bull markets. Golden crosses. Yeah, a lot of golden crosses. Give me just 1 second. Pull up. So we saw the dollar, right? One of the first charts. And the 50-day was crossing below the 200-day. That's called a death cross. And then basically a golden cross is the opposite, where the 50-day crosses above the 200-day. So let me see. I had a list of them. Yeah, here we go. So I'm going to go to a daily chart with a 50, 200-day. Take off this 100. We don't need that. So the blue line is the 200-day, and the yellow is the 50-day. So I talk a lot about trends, like a primary bear market trend. So the financial media will say a 20% move off the lows is the new bull market. They said that about the Dow just a month or two ago. I did a whole video on it. The NASDAQ is almost 20% off its lows. If that happens, you're going to hear CNBC and all the time, NASDAQ's in a new bull market too. Are we in a new bull market? My opinion, first of all, my opinion is that the 20% rule is completely arbitrary, because 20% for the Dow is something very different than 20% for, say, something like Tesla. For Tesla, is like a blip. For the Dow, it could be, a primary trend changing event. So I go by price action. So basically, we have a primary downtrend over here. We're looking at IEF, but we can look at the S&P 500. So I look at this in terms of higher highs, higher lows, or lower highs, lower lows. So this over here was a primary downtrend. A quick, easy, dirty way, I think, if you want to kind of identify them, would be the 200-day would basically represent your primary trend. It's pointing down and heading lower. The 50-day would more represent like your intermediate trend. And I would say like the 22-day or somewhere in there would be like the sub-intermediate trend. So when we talked about golden crosses, and let me just see if I got this question right. These all point to bull market. Is it possible the recession doesn't start until 2024, allowing a rally now? Anything's possible. Yeah, I mean, I don't like to project out that far. I will tell you what my 3 phases are, my ideas are about that. First of all, we have a golden cross happening right here in the S&P 500, right? The 50 days crossing right above that 200-day. I hope you can see this. I can zoom in closer. So we got that in the S&P 500. We have the same thing in small caps, doing it right here. And if I back out a little bit, you can see, both of these have been trending down. Remember, in like September, October, I was saying I think the market is going to transition from a primary downtrend to an intermediate lateral trend. So we can see that with price itself on IWM. You see the June low here and the October low. There's no lower low there. Okay, so the intermediate trend is starting to change. I said that I think we're going to get a big range, so kind of like a big lateral choppy range. So we could say, you know, maybe over here 201 in this scenario, and down here, you know, like in the 162, 163 area. But the point is the intermediate trend, which again, back here we're looking for them to start turning sideways out of a primary downtrend. That's not to say the bear market is over, but this is an expectation I've had for months. So we can see, again, the 50-day is crossing above the 200-day. That's another golden cross. It's the same thing for the Dow, except the Dow did it a little while before. Remember, the Dow led that rally off October's lows right over here. I'm going to zoom in a little bit more. I got so many programs running that it's a little bit slow. There's the October rally. So this is that 20% move. And then the Dow's pretty much done nothing since then. But there's a golden cross in the Dow. It is kind of lingering around this 50-day. But transports are, to me, much more interesting. They tend to lead the market more. They tend to be a leading market signal. Actually, DJ20. So here's the transports. Again, another kind of golden cross and very, very bullish price action in transports. Let me pull up these trend lines here and go out to a 60-minute chart. So very, very bullish price action. Again, this is another one that has that golden cross going on. So bullish, kind of an ascending triangle, you know, breaking out well 2/3 into it, bull flag. And again, that is another one that has that golden cross. Also semiconductors, the SOX index. Same thing, the golden cross right over here, the home builders. I mean, you could just go on and on and on. There are a lot of them, plus we have the dollar doing its death cross thing. I guess we can get into the concept of the three stages I'm looking for, or that we're kind of experiencing. Stage one, if you're like a long-term subscriber, you know that during the rally of 2021, I kept saying that, first of all, we had horrible market breadth. We could see inflation wasn't transitory because our copper gold ratio back in March of 2021 was saying the 10-year yield should be like 2, 3, 4 times higher than it was. So with all of that said, my expectation coming into 2022 was that the Fed is going to have to fight inflation. And to do that, they're going to have to hike rates and they're going to have to cut back their balance sheet. And the Fed will intentionally put the U.S. economy into recession. We already had a recession this year, 2 negative quarters of GDP, but they didn't acknowledge it. You know, they said, oh, employment was strong. Let me tell you something. Employment is not a leading indicator or any kind of indicator for a recession. Usually we are well into a recession before the unemployment rate starts to move up. And usually we're a year to a year and a half out of a recession before the unemployment rate starts to come down. So it is the most lagging, terrible indicator as far as, you know, looking at bull markets and bear markets and all that stuff. But the Fed is concerned primarily about wage inflation. So phase one is the market senses the pivot, senses peak inflation, and senses peak Fed hawkishness and rallies on that. I've gone back to like 1915 on the Dow and looked at bear markets and counter trend rallies. And I would say 90% of the counter trend rallies from a bear market had something to do with the Fed. The Fed did something like they cut rates by a little bit, like a quarter basis point or something. They said they're looking at cutting rate. Almost every single time it's instigated by something the Fed said or did. So that's what I think we've been basically seeing in this phase one is the market basically sniffing out peak inflation and peak rate hikes. If we look at the NASDAQ 100, I mean, talk about a change in character. And we'll just look at this blue 200-day. We don't need the other one. Let's
suppose I can clean that chart up a little bit. I mean, look at the change in character here, that this 200-day has been resistance the whole year, hasn't spent more than 1 day above it. Couldn't even get up to it here. And look where we are now. You know, we got 1, 2, 3, 4, 5, 6 days above it. So again, this doesn't mean that we're heading into a new bull market, but this is a change in character. I think we're kind of towards the end of phase one, the market celebrating peak inflation, peak Fed hawkishness. Phase two is check please. The bill comes due for the Fed's fight against inflation. So those 75 basis point hikes that are already in the pipeline aren't even being felt in the economy yet. I think by March of this year, they'll start to be felt in the economy. So they have about a 6-month lag. So we have a lot more, as far as policy, a lot more hawkishness in the pipeline coming. And I think you're going to see the market or the economy go into recession. And at that point, I think this party ends and we reestablish the bear market with new primary trend lows. While we're on the topic of recession, I want to show you two more charts. And these, you know, everybody can have an opinion as far as what they think is going to happen, but I'm looking at probabilities, like what are the probabilities of what's to happen. So I'm going to come back to my PowerPoint presentation, and that's not it. Sorry. I have like a whole studio program here. I feel like I'm like producing the evening news. So what we're looking at on this chart, let me just pull up my own so I can see a little closer. Okay. This is the 10-year yield minus the 2-year yield in blue. These gray areas are recession shading, and this is from the St. Louis Fed's website itself. Okay. So this is the 2s and 10s yield curve. And this black line represents kind of like zero. So above that, yield curves are steepening. Below that, they're actually inverting. So since World War II, the 2 and 10 yield spread, every time it is inverted, come under this black line, since World War II, a recession has followed. So here in the early 80s, under that line, recession. Early 80s, again, inverting, recession. That's a double dip recession. And a little bit off topic, I know I'm a little bit all over the place, but there's a lot to share. This is when Paul Volcker, who was the head of the Fed back then, was really going to give the market the hard medicine to kill inflation. And what happened was he did bring the Fed funds rate up to, I don't know, maybe 18%. I was getting like 10 or 11% as a kid on a savings account in interest. I mean, those days are long gone. But then the economy went into recession, as you can see here, and he got a lot of political pressure, and he started cutting rates to deal with the recession. Before inflation was completely subdued, inflation became resurgent, and then he had to lift the Fed funds rate up to, I think, almost 20%, 19 to 20%. I mean, imagine that. Like 20%, we're like at 4.75% right now. That caused this double dip recession. That's the mistake the Fed doesn't want to make right now, is to start easing too early and have inflation become resurgent. But again, the point I'm getting at is every time we get an inversion, it's followed by a recession. Here is right before the financial crisis right here. We even got an inversion right here before the COVID sell-off and all the COVID lockdown and all that. But I have to tell you this one thing. The Fed was kind of trying to, I can't remember how long ago it was, but the 2s and 10s had inverted. I think it might have been, it was in the last few years. In any case, the Fed said, well, we did studies and we find 3-month 10-year spread is more reliable and it hasn't inverted. So a recession is not coming. And then like within weeks of them posting that study, it inverted too. But here's the Fed's preferred measure. And this is the 10-year minus the 3-month. Again, recession shading in gray, and below this black line is inversion. So inversion, recession, inversion, recession, inversion, recession, inversion, recession. Look how deeply inverted we are now. So just based on probabilities, yes, I think absolutely we're going to have a recession. I don't know how long, how bad, but I do expect it this year, probably the second half of this year. And then that's why I think the Fed won't be able to keep rates at their peak whenever they hit the terminal rate for the rest of the year. I think they'll have to cut because I think we'll get a severe recession. And it's not always just the question of a recession, but every Fed tightening cycle, they break something in the financial system. And that becomes the next crisis. So beyond the recession, I don't know what that's going to be. In September, we saw some really strong signs of stress in the financial market. The Fed dialed back their hawkish rhetoric, and those signs subsided. So I don't know what it's going to be, but I think recession probabilities are like 95%. And I would say this year, second half of this year, probably 60-40. I'm leaning towards that. And then we'll have to look for the bottom and the start of a new economic cycle and a new bull market. So I hope that answered the question. I'm going to look at comments again here real quick. So if I was expecting a new bull market, I don't think it would be this year. Of course, I could be wrong. I don't think I'm wrong about the recession, but whether it's a real fast, sharp recession or it's kind of dragged out over a longer period, I don't know. One final thing on yield curves, I said every time they invert, we get a recession. But the inversion is just the first part. That's kind of like the warning, a recession's coming. You can see this yield curve is inverted the most since like 1981. As far as timing a recession, after inversion, the steepening right here, see this major sharp steepening of the yield curve, that is like the trigger. So this is kind of like pulling back the hammer with the inversion, and this is pulling the trigger on that recession. So you see it almost every time. Inversion, sharp steepening. That sharp steepening is generally the Fed cutting rates. Okay, let me look at questions. Matter of fact, guys, I'm going to take just like a 30-second little break because I've run out of water. I'm just going to grab some water, and I'm going to put up this nice little be right back graphic. I'll just be a second, though. Okay, looking at the comments again. So on the dollar index, I told you that we have a really strong inverse correlation presently. That is what we have right now. As far as like learning lessons and putting these like in your little mental playbook or your toolbox, I don't want you to think that in every environment that a strong dollar is bad for stocks. It depends on the economic environment. So some people call it the dollar smile. Like there's 3 different basically relationships that the dollar can have with equities. So I can give you like an example. I can't remember the exact time frame, but I think it was around 2016, 17, somewhere in there. When the dollar was going up, what it was showing was the US was in a much better economic condition than like Europe or some other areas. So money, the dollar going up was a reflection of money flowing out of other countries and into US markets. So at that point, a rising dollar was actually bullish for stocks. Okay. The dollar can also be, if we don't have like really crazy things going on, like super high inflation, the highest inflation in 40 years, or a bear market, if we don't have real crazy things going on like that, it can also be a reflection of central bank policy. So the ECB would be, one of the main ones, or the Bank of Japan, the Bank of England, but the European Central Bank would be one of the main ones. So if the European Central Bank was more hawkish than the Fed, like say they were raising rates while the Fed was basically doing nothing, then the euro would tend to rally against the dollar, okay? And vice versa. So what we saw this week actually, because we did have the Fed and then we did have the ECB, is that we saw the ECB came in much more dovish relative to the Fed, and then we get this dollar spike. Let me take off, oh my gosh, I should take off this be right back, but yeah, I'm going to do that for you. And head back to Thinkorswim. Hopefully you can see that. Yeah. So that's the dollar spike. But a lot of this was just basically the Fed coming in and looking, or I'm sorry, the ECB coming in and looking more dovish relative to the Fed. So that will also drive prices. But this big thing right here, this big spike before the market opened, 8:30, what comes at 8:30? The payrolls report, and then the rest of the economic data with the services and all that. So this is reflecting much stronger data, which kind of says, well, maybe the Fed is going to have to stay tighter for longer. That's why it moves up. That's why equities move down on that. And that is why gold dumped, because gold has a really, really strong inverse correlation with the dollar and with yields, just like stocks. So there's gold dumping below 1900. And again, that's all connected to the same thing for the same reason. When I see gold pull back that much, then yeah, I think that we will see more of a correction in stocks, even though as of Friday, we were sitting here trading in these bull flags. And I'm just going to pull that up real quick again. I'm telling you, you got to see what all this stuff I've got going on this side. So yeah, I mean, this is my expectation that we rally, but with gold, let me just throw gold on there 1 minute, or GLD, so you get some idea how much those two dynamics affected this asset that has been trading very similarly to stocks. And I'll start them all at the same point. So this is a normalized chart that you're looking at. So from this point, the price percentage gains are reflected accurately rather than just the trends. But I think it might be easier to just look at the trends. Okay, so in any case, here's my point. Made very well by gold. Look, both gold in blue, GLD, and the NASDAQ are rallying out of that December range base. You could actually say gold led the rally here. It started before. So now we can say that gold is leading this consolidation correction that, if you remember, you know, that was basically my take as soon as we hit this 12,785 target on Thursday. So yeah, that's my take. And as far as what I said about gold, 1900 is absolutely crucial. Let's see. Reading the comments again here. I'll say a little bit more about, you know, some questions about whether or not we're in a bull market. And like I said, I don't think so because of the three phases I think we're going through. I think right now we're at the happy phase of stage one, where peak inflation, peak Fed hawkishness has been reached, and the market is basically partying on that. You know, it's kind of like the pivot or whatever. But I do think phase two is the bill comes due. And the bill for fighting inflation has been raising rates and basically engineering a recession. That's what the Fed knew it was going to happen. This is what I posted in 2021. That was that the bigger problem for the Fed between a recession and inflation is inflation. And the Fed will cause a recession to fight inflation. And that's what's coming next. So I think at that point, we'll see stocks acting ugly again. We'll get back into a primary bear market, and then we'll start looking for the base and the bottom to start a new economic cycle and a new equity bull market. Ken asks, how long will the stock market's exuberance last before reality sets in? You know, that's a great question. And Thursday morning, or was it Thursday morning or Friday morning, one of the early updates, that's what I said. I said, I think the market is looking frothy here. It's feeling very speculative, like a lot of FOMO. People who've missed out on this move are chasing prices 3% higher on the day. So I do think we're getting towards a more bullish sentiment extreme, and extremes in sentiment are almost always contrarian indicators. You know, price at its core is basically just a reflection of human psychology, mass psychology. So if you wonder why, you know, a bull flag here in 2023 works just as effectively as one I can find in the Dow in like the year 1916, 1917, it's because it's a reflection of human behavior, and the two human emotions that drive prices, fear and greed, those don't change. This is why these patterns work. It's why they're so reliable, whether it be a daily chart, if you're a long-term trader, like I think I showed one of these on Dow Transports on a daily chart. Let me pull that up. Sorry, I know it's a little bit messy. I'm gonna get rid of all these moving averages. Don't need them. But the point I'm getting at is whether it's you're a day trader and you're looking at these on a short-term basis, or whether you're an investor and you're looking at these same patterns on a long-term basis, there it is. There's this big bull flag. It breaks out. It does what it's supposed to do. It's a continuation pattern. Consolidation, continuation. There's the rally. There's the consolidation. There's the continuation. So this is between November and January. It's huge. But if we go back, to the last chart, we saw smaller ones. And the reason that these work is they're just a reflection of human psychology. Can get back to that question there. Yeah, I do think the market is getting frothy here, and I think we really need to pay close attention to that. I'm not sure it's quite hit the sentiment extreme, but there's definitely a lot more of a sense of FOMO, more short covering as we expected. Let's see, what else? Okay. Thank you for the comments. Thank you. Thank you, Jen. The recession, okay, Grow says the recession doesn't start till the yield curve uninverts. That's exactly what I was saying. That the inversion is like the warning, but that sharp steepening is kind of like the trigger, like, here it comes. So when it starts steepening quickly, you'll know that we'll be close to that recession. And recessions are always identified in hindsight. I mean, we can look at the economic data. We already know manufacturing in the US is in recession, but 70% of our economy is services, and services just kind of accelerated on Friday with payrolls report looking good too. Okay, so Mark says, I don't see it as likely that the market will crash much further than it already has, considering the USD is down 20%. I kind of agree with you, and like I said, I've been looking for, since, I don't know, September, October, I've been looking for the market to make a more lateral or sideways turn, which we can see really well here in small caps, right? So here is the primary downtrend, and now it's moved into this lateral phase, right? This kind of big choppy range. This is what I was expecting, back in August, September, October. So we're seeing more and more of that. But I do think once we get into a recession, or actually before it a little bit, we'll probably see the market make a new primary bear trend lower low and reassert itself. That doesn't necessarily mean a crash. I mean, people confuse crashes with bear markets. They're not the same thing at all. But let's see what else we have. Scott, all-time record in call purchases hit last week. Retail is back, baby. Yeah, that's what I was sensing on Thursday, was a lot of frothiness in the market, a lot of FOMO, fear of missing out, chasing prices. So good comment. I appreciate that, Scott. That's a nice observation. ODT, okay, Arthur, yeah. I'm getting the impression that yields will continue to go down during the recession. So I mean, at some point, what's going to happen is yields are going to reflect more the economy at like the 10-year out to the 30-year. The 2-year is what the Fed controls. The Fed funds rate, they control the short end, but the economy, the market controls the longer end. So before we got that COVID crash of 2020, I had like maybe 5 weeks of videos out beforehand, pounding the table. Like, we didn't have any COVID in the United States at that point. I'm not even sure if it had made it over to Italy at that point. I think it was still basically in China, and they were still calling it the Wuhan flu. So this is just telling you how far back that was. But the point is, I was pounding the table because we were seeing yields drop sharply. We were seeing crude oil drop sharply. Natural gas, all kinds of commodities were dropping. And when they had these real big 20% kind of moves, and the yields were doing the same thing, and if you kind of overlaid them all, they all look the same, except for stocks making all-time new highs. I was like pounding the table that this is a very, very deflationary signal and like market crash kind of signal. And that's basically what we got just a couple weeks after that. So yeah, I wouldn't be surprised if yields come down a little bit. Let me just show you one other thing real quick, and then we'll take some questions and then kind of like wrap this up. But I want to show you some market breadth indicators, because this is what is really impressive. In 2021, when the market was rallying, I saw some of the worst breadth that I've seen in over 2 decades of doing this. I mean, every day the market's adding a new record high by 0.25% or something like that. But it was just horrendous how bad market breadth was. And I just knew, like, at some point, this is just going to come falling apart. So right now, I'm going to pop you over to some breadth indicators. Let me just switch screens here. Okay, so what you're looking at is the S&P 500, 30-minute chart, and this is the NYSE's advanced decline line in white. Let's go to like a 60-minute chart. Actually, let's stay here for the moment. So one of the things that told me that 4150 S&P measured move would probably be hit, which would require the S&P breakout above 4100, where it had really bad resistance right over here. One of the things that told me this was the advanced decline line was leading prices higher, even though the S&P wasn't at 4100 at that point, wasn't even really close. We saw more participation, more stocks advancing. So if we look back at this, let me do like a 60-minute chart. This is the top of the bull market right here, December, right? And then we come into January, and that is our bear market. So usually advanced decline lines don't give a lot of great signals, but when they do, they're powerful. So you can see this advanced decline line, the S&P is just below 4,200, but we have an advanced decline line that is at or, around levels of the last market high. So very, very strong breadth that I've been seeing. That was one of the things about the October rally. A lot of times it looked like, well, this is a counter trend rally, it should reverse. But every time I looked at breadth, I was like, this is really, really strong. So we still see a lot of stuff like that. Let me try one other here. This is, and you can see how horrible the breadth is right here. So let me explain what this is first. Again, we're looking at the S&P 500, and this white line is the percentage of NYSE stocks that are above their 200-day moving average. So you can see it's 64%. But what my point is here's the market high, and you can see fewer and fewer and fewer stocks were above their 200-day. That's bad news. That's a leading negative signal. And this is the stuff we were seeing all of 2021 through that bull market. It looked very fragile. But look, as we come into this October low, the little bases here, like Dow had a W base, IWM W base. We had inverse head and shoulders in the S&P and basically in NASDAQ. You can see we don't make a lower low with this breadth indicator. It makes a higher low, even though price makes a lower low, and it actually diverges higher here. So it's starting to lead prices higher, right? Here's our little 4,100 area that S&P couldn't get above. Look at this. I mean, look how this is leading. It's well above levels from the last bull market. So again, just another example of really, really strong market breadth. The whole October rally to like November, that was led by the cyclical stocks. The mega caps barely participated. And then from December over here, they were like a major anchor on the market. So now we have the cyclicals participating, but we also have these heavily weighted mega caps participating. So when I see breadth like this, I'm not real fond of like jumping in on the short side with both feet. Some tactical trades here and there, yeah, but very strong breadth. Let me see, I'll show you, let's try this one. A couple standard deviations above the 200-day. So again, this white indicator is the percentage of NYSE stocks that are trading 2 standard deviations above their 200-day moving average. Positive divergence into that October low. leading higher. I mean, S&P is just barely, pretty much around the same place it was in December, just barely. It's well below the August highs, but look at this indicator. So these breadth indicators, I've got about 30 of them. They all look fantastic. So I think there's still some room for the market to maybe go a little bit higher, but I think we do have to go through a consolidation phase that started. But these are very strong signals still. All right, I'm going to check the comments again here real quick. Could the market reach the previous highs before the next downturn? It could, but I don't feel it's very likely. I think that's a pretty low probability. I think the S&P is going to struggle really at 4,200 if it gets there. 0.1% off 4,200 this week, but 4,200. Let me just put a trend line in there at 4,200, and I'll show you what I'm talking about here. That's about 42. Let me adjust that. Okay, and what I want to point out is, yeah, so we have a little bit of overhead supply here. That's nothing real big, but this is basically kind of that topping phase. It's almost like a head and shoulders top. This is a major, major source of overhead supply, which means people who bought up there, who've been at a loss for a year, and they're praying to the stock market gods. Please, please, please just let prices come back to 4,500 where I bought, and I'll sell and I'll get out. I don't need to make any money. I just don't want to take a loss. People don't like taking losses, right? So this is overhead supply at 4,200. It's a massive zone. It's basically the S&P's top. So that's why I think that's going to be a really, really tough zone to trade much higher above. But yeah, as far as your question, I don't really see that as being a high probability. I see a more lateral price trend, which we're seeing in the NASDAQ 100 right now too. Actually, let me just take off these trend lines so we can just look at price. You can see it over here, more of a lateral price trend right here with a higher low, and maybe prices come up higher. But this is what I've been looking for, is more of a lateral price trend, intermediate term, and then the primary downtrend to resume. And that would basically be when we really start getting into the nasty part of a recession. Okay. Oh, thank you, Ken. And Ken has been with me for a long time. Thank you so much, Ken. Thank you, Brent. And welcome, Brent. Welcome on board. D. Frank, how do you get these indicators? Which ones are you talking about? Thank you, Mark. Thank you, Scott. Appreciate it. Thank you, Michael. You got to give me an email. Let me know what you're up to lately. Oh, thank you, Art. Art, this is Art. Oh, gosh. God, this guy been with me forever. Great, great guy. That's what I'm so thankful for, too. All my subscribers have been just fantastic people. To get that many good people in one place, I'm so blessed by that, I have to tell you. Why am I so certain there'll be a recession? That's based on the yield curves inverting, and it's just with the 2 and 10 that has inverted. It is called every recession since World War II. So I can't say anything with 100%. You never can in the market. You're looking at probabilities. That's very strong probability of recession. And actually, the Fed may not come right out and say it, but the Fed has engineered a recession. They want people to stop spending money. That's why they want to see the unemployment rate go up. They want to see wages come down. They want to see economic growth come down, so inflation comes down. Inflation is enemy number one, because at a certain point you go from just inflation to hyperinflation, which is more of a psychological. Oh, thanks, Sam. It's good to see you. Good to see you. So anyway, going into next week, like I said, we do have some pretty nasty signals coming from gold, and sharp move in the dollar, sharp move in yields off of the very strong payrolls report and services report. But looking at price only, all I can say is that we do have the consolidation starting exactly where you would expect it to start, at the measured move target for the NASDAQ at 12,785, which we hit right here on Thursday. Price went a teeny bit above, came right back down, and what's it doing is consolidating in that area. Same thing with the S&P 500 with its measured move target of 4150, which is right here. So we do have bullish flag consolidations. The only one that the Dow really doesn't have much going on at all. So the Dow is just a sloppy mess. I'm not reading anything into that. Small caps may have an ascending triangle. The neat thing about an ascending triangle, real quick, is that if you do extend these trend lines out into the future, and assuming that it holds up like this, it doesn't become a bigger pattern, or it doesn't become something else. I guess we'd have to go pretty far out, but for the sake of this example, let's just say the trend lines converge next Thursday at right over there. So basically, this would tell you that point of the apex. That would tell you expect price to break out by the time we get to that apex, but with a very strong price consolidation, a very bullish one, they'll usually break out about 2/3 of the way. Usually you'll get about 5 pivot points, like 1, 2, 3, 4, 5, come down and a breakout, something like that. So the way that we ended the week, we were in kind of consolidation mode. High yield credit was sending a consolidation signal. Yields were definitely sending a consolidation or correction signal for equities. Semiconductors underperforming a little bit. So a lot of things were saying consolidation, continuation pattern. And right now, all we can do is look at the price that we have, which has a bullish bias, and keep monitoring that and look for, the positive divergences showing up as these, bullish patterns develop a little bit more, and look for the market signals, which includes yields. It includes the dollar. It includes high yield credit. I mean, high yield credit is one of my favorite, and we're just very, very overbought right now. So I think it's just a perfect time. Sorry, I didn't even realize I didn't have this chart up. Horrible of me. Told you I have a lot of things going on all at once here. But in any case, yeah, S&P 500, bullish flag into the end of the week. NASDAQ, bullish flag into the end of the week. IWM looks more like an ascending triangle, like I was saying about extending those trend lines forward into the future. When they come to an apex, that's pretty much your date where you expect to break out. But that's all I can say at this point, is that we had a really good run, hit the measured moves. The next highest probability is to consolidate, and that's where we are. So hopefully you guys were able to see all those charts, because I know I had it on the wrong chart. But is there any other charts you want to see, any that you missed or that you'd like to see? Okay, well, if you aren't, or if you're a subscriber, you can always email me, of course, anytime. And I'm going to leave the contact information, my Twitter account, if you want to follow that, the website and stuff, in the description of this video, so you can reach out to me there too. The new website, you got a little taste of it in the intro. I'll play you the intro again, and then we'll get out of here. Here's the little intro. The new website is coming along. Get a little bit of an idea of where it's going. If you are a current member of Wolf on Wall Street, before that new website goes live, you will be grandfathered in at the same price that I had in 2008. Otherwise, the price will be going up a teeny bit because inflation. I haven't changed my prices since 2008, so it's time. But if you are a member, if you subscribe before the new website goes up, then you will be locked in at that. So thank you very much, everybody. Really appreciate you being here. If you have ideas about how I can do this a little bit better, or things you'd like to see, please email me. I want to just provide whatever is most useful for you. So with that being said, have a fantastic weekend, everybody. And thanks again so much for coming by.